Today was a rough day for stocks, for bonds, for crypto. Basically, any asset class that you are invested in did not do that well today. I have a warning, it could get worse from here. In this video, we will unpack exactly why that is, where these markets could fall, and what my expectation is. Before we get into it, hit that like button as well as subscribe to the channel. Let me know down below in the comment section what you think about this information down below. So this market drop that we're seeing today, the Nasdaq down well over 1%, actually started yesterday, and it has to do with the bond market. If you take a look at TLT today is down about 0.5%, but yesterday TLT was down about 1.9%. When TLT falls, that means 10-year, 20, 30-year treasuries are rising in yield. So over the past 2 days, 10-year treasuries have really started to take a steep rise to the upside. 10-year treasury yields are currently up about 3 basis points on the day today, but 2 days ago they were trading at about 4.20%. Today you're at 4.36% if you round up a little bit there. So you're up 16 basis points in the last 2 days. This is the highest 10-year treasury yields have been since November of 2023. So anytime you start to get close to this 4.5% level on 10-year treasuries, you start to get jitters in the markets. And that is pretty much happening today. That's the only real thing that is going on in our markets today. We didn't get anything hawkish from the Fed. The data that we got today was really kind of a nothing burger. The data that you got yesterday did give the markets at least some kind of reaction. That was ISM manufacturing PMIs. They just went positive for the first time in a long time, but really ISM manufacturing prices beat big time. So prices are rising in the manufacturing sector. That came in at 55.8. The estimated number was 52.5. So bad inflationary data yesterday in the manufacturing sector. Today you had JOLTS job openings that pretty much came right in line with estimates. The number that was estimated was 8.75 million job openings. You came in at 8.756 million job openings. So like literally right on expectations. You did see JOLTS job quits come in a little bit higher than expectations. The expectation was 3.37 million. You came in at 3.484 million. So some people are saying that implies people are quitting jobs because they feel like they can get a better job. But overall, this doesn't really make a lot of sense to say that's causing the markets to fall. It's not. 10-year treasuries are reacting to a multitude of different forces that are at play right now. You just entered into Q2, the last couple of days of Q1, you did see some money going into bonds. So a little bit of a pullback to what you've seen towards the end of Q1. That's definitely happening. But a lot of what's happening in the bond market is saying the Fed's not going to be cutting rates nearly as much as the markets expect. And let's be honest, the bond market has been saying that for many months, but now the markets want to respond to it. And in my opinion, that's because you're out of Q1 and now you're in Q2. And Q1 was one of those quarters where it was just so strong, up almost 10% on your broader indexes. Q2's not going to be a 10% gain. So some funds are like, hey, we'll just take the profit that we had. We know markets are prone for downside here. We need to see a correction. We'll sell out of stocks now or really hedge the portfolio big time and just wait for better prices. And I think that's a big part of what you're seeing in the markets the last couple of days. You've also had investment banks like JP Morgan come out and say we could see a 20% drop in the markets basically for no reason because stocks are overcrowded, valuations are high, and everyone is expecting the best case scenario, which that also doesn't help sentiment out there broadly, but I don't think this is having much of an impact to what's going on. You've also had Goldman Sachs and other investment banks as well say the same thing. Bank of America, they kind of lowered or downgraded the tech sector of our markets because of some of the main highlights that JP Morgan points out: overcrowding, not really priced for bad news, things of that nature. So there's been a couple little pieces of news here and there, but none of those reasons are likely the reason why the markets are falling today. I really think it's as simple as Q1 was so good, hedge funds are taking their profits and they're going to wait for better prices to buy. And I think that is kind of a self-fulfilling prophecy. When you get big money that starts to think like that, it's only a matter of time before you do see a larger downside correction. And I do believe it's true. Stocks are not priced for bad news. So if we do get bad news, it could turn into really bad news for equity markets. Now, one thing that's notable on the NASDAQ today is the NASDAQ has broken down. You did get this gap down today. NASDAQ's currently down about 1.15%, but you're holding support at this 438 level, this line I have drawn here. You bounced pretty much right at this level today. $438.03 on the triple Qs. If you hold 438, then it doesn't look too bad. You've definitely broken the uptrend, but it doesn't look too bad. You could kind of trade sideways here. If you fall under 438, that's where you look at bigger downside, potentially as low as 432. And then after that, you could be looking at about 420 on the triple Qs. But I think we need some kind of bad news in order for us to get there. And as I said in the last video, if there was a week to get bad news, it's probably this week, because we do have a lot of economic data coming out still to come this week. The biggest data will be on Friday, so that's the big day to be watching. But there is data coming out tomorrow as well. You are going to get ISM Services PMI. Just think back to what ISM Manufacturing PMI did yesterday and what it did to the bond market even heading into today, and subsequently the NASDAQ being down over 1%. If you get ISM Services PMI coming in hot tomorrow, especially the prices component, yeah, you're going to be in for some downside in the markets, that's for sure. And it's really going to force the markets to kind of recalibrate their expectations for Fed policy. Tomorrow, you're also going to get Fed Jerome Powell that will be speaking, and some other Fed officials. Powell will speak at about noon tomorrow. I'm not really expecting any kind of big change if the prices component of the ISM Services PMI comes in hot. Maybe Powell could be a little bit more hawkish or bearish, but Powell is like a full bull right now. He is waiting just for a reason to start cutting rates. I don't know if he gets that, and I don't know if the markets would take that as positive if the Fed does get a reason to start cutting rates, but Powell definitely wants to start cutting rates soon. Even other Fed officials, they're not nearly as bullish or dovish as Powell is. Tomorrow morning, I can't leave this out as well, you will get the private payroll change. This is kind of the closest thing that mirrors the non-farm payroll report, which does come out on Friday, so markets will pay attention to that. The estimate is 125,000 job ads. Last month's number came in at 140,000 job ads. So if you come in higher than 125,000, it's hard to say. The markets might not like that because it's showing the economy is still really strong. The job market's still really strong. But the true investor part of me says, if people are working and more jobs are being created, that is good news. So I don't know how the markets will take it. You know, obviously, if you come in really low on the jobs report, on the ADP employment change, markets are probably not going to like that. But if you come in really hot, markets probably won't like that as well, but I would much rather come in really hot than really low. We also have Bitcoin and other cryptos that are really selling off as well over the past 2 days. Yesterday, you did see about a 5.5% pullback on Bitcoin. Today, it's about a 1.5% pullback. So why is this happening? Well, there is massive liquidations that have started to happen. 121,325 traders were liquidated, contributing to a total loss of $395.1 million. And we know Bitcoin's heading into its, infamous halving event later in April, and that's definitely going to add to the volatility. I think one of the real questions is, for me, is that event, that halving event, going to be a, buy the rumor, sell the news event, or kind of like we seen with the ETFs that got launched with Bitcoin? People thought it was going to be a buy the rumor, sell the news event, and crypto kind of traded sideways after the ETFs, and then it's been off to the races ever since. I'm not exactly sure, but crypto could be having an effect to stocks as well, or stocks could be having an effect to crypto. Both of these asset classes really going hand in hand the last 2 days. There's also been a shift in sentiment. Adding to the uncertainty, recent reports from QCP Capital have revealed a surge in perpetual funding rates on these platforms, soaring to a whopping 77% before abruptly falling. This underscores the rapid shift in market sentiment. On April 1st, marked a substantial net outflow of $85.84 million from Bitcoin spot ETFs, signaling a sentiment shift in the market. Moreover, broader global economic instability, exacerbated by higher than anticipated inflation rates in the U.S., further doused hopes for looser monetary policies and interest rate cuts. Matt Simpson, an analyst at Citi Index, says Bitcoin tends to ride a roller coaster of peaks and troughs after hitting record highs. The impending Bitcoin halving scheduled for April is anticipated to drastically reduce the creation of new Bitcoins to just 450 per day, stoking further market uncertainty. And that's really why a lot of people are bullish on this event, because if you half the amount of coins that are being produced every single day, well, that means simple supply and demand dynamics. That should mean, well, Bitcoin should go higher. But again, that's not guaranteed to happen. And Bitcoin falling is obviously having an effect on Ethereum, and it's having an effect on your smaller coins a lot more than obviously Bitcoin. Bitcoin is like the gold standard for crypto. So the other coins, they've really got whacked over the past couple of days. Some of the main reasons I think you should be a little bit defensive here, and why I personally believe stocks have quite a bit of ways to fall. Look at the StockTwits SPY, right? Over on StockTwits, you have the SPY. You can look up any ticker you want. This is a pretty good gauge for retail investor sentiment. And right now, sentiment is higher today than it was yesterday at 63. So retail is still very bullish on the markets, being a contrarian indicator to say, if people are still this bullish after you've hit a high, you've come down, you've technically broken now into a downtrend on the S&P or the NASDAQ, and people are this bullish still, it means there's a lot of room for people to switch from being bullish to bearish. And by the time everyone's bearish, that's probably when you start to get your kind of bottoming to the correction. For 2024, markets are still pricing in 1, 2, 3 rate cuts. I think there's room for that to drop to 2, if not even 1 rate cut for 2024 over the next couple of months. Tomorrow's data could be important in doing so. If we do see ISM services come in hot, then that's going to be a problem, specifically the prices paid component. And again, you have broke into a technical downtrend now on the triple Qs as well as the SPY. And I think the simple fact of the matter is, if you're looking at what drove the markets higher, especially in 2024, it was not just every stock out there. It wasn't a broad-based rally. If you take a look at the percent of stocks above their 50-day moving average, you have, 54% of stocks above their 50-day moving average. You actually hit the highs at about 86% of stocks above their 50-day moving average on December 28th. As soon as you started 2024, you actually seen the average stock start to decline. And you really haven't seen the average stock do much of anything in 2024. It's your AI stocks that have really led the way higher. The problem is expectations have gotten carried away for what these AI stocks are going to report over the next coming quarters and over the next coming years. Things would have to go exactly as planned, then better than that, just to justify where Nvidia, SMCI, and all of these other, quote unquote AI stocks are at. I think that's always a pretty dangerous market if expectations are this high and everyone's expecting great things. That means any kind of bad news is likely not priced in. To the contrary, when you're buying stocks after a crash or a large correction, there's typically a lot of bad news priced into the markets or into stocks. So even if you get bad news, a lot of the time, stocks can just rally anyways because it's maybe not as bad as feared. You're nowhere close to that right now, just judging off of the largest stocks in the markets that really control the broader S&P and the NASDAQ weightings. Think your big tech, your Magnificent Seven stocks, they are priced for absolute perfection. Now, when do you go through a larger crash or correction event? I think that's the hardest part to kind of pinpoint. It could be earnings. If earnings underwhelm, well, that's a problem. Markets right now are trading at about 21 times next year's earnings. If we're correct that earnings are going to grow about 11% this year and about 10% next year or so. If earnings start to really underwhelm and they're not as good as expected, people are really going to have some doubts about 2025 earnings. And then if earnings estimates fall, let's say from $260 per share of EPS for the S&P, let's say for next year. If that starts to drop to, let's say, $245 per share, if the estimates come down, then maybe you're really paying 22, 23, 24 times next year's earnings. And that's where the valuation really becomes stretched on our markets. So long story short, the markets could fall sooner rather than later. I would imagine you actually start to get that drop once we get earnings, but really this week could start a correction-like event, especially if tomorrow's data does not come in good. Maybe Powell does take a little bit more of a hawkish stance. I'm not expecting that tomorrow, but it's a possibility. And then really your Friday data with the non-farm payrolls, that's going to be a huge catalyst and likely really just shift the entire market sentiment either back to really good, really bullish, or not so good. In my opinion, it's not really a question of if, but a question of when we get a 5 to 10% pullback from here, better known as a correction. Also, with that said, I do believe a lot of areas in the markets like small cap, interest rate sensitive names, they've already seen quite a large correction in 2024. Those are not really the areas of the markets that I'm worried about or, thinking need to go through a correction. It's really your big tech stocks, your AI names, the names that really drive the broader NASDAQ or S&P index higher. Think Microsoft, not even Apple. Apple has went through quite a correction from its all-time high, but think Microsoft, think Amazon, think to a lesser extent Google, Nvidia, some of those stocks. Those could be the ones that are most prone to any downside here. Let me know what you think about this information down below in the comment section. Hit the like button as well as subscribe to the channel. Keep in mind, whatever happens in equity land can have an impact to crypto as well, especially as you get closer to the Bitcoin halving and as there is presumably going to be some profit taking. We're already starting to see some net outflows because of that uncertainty and because you really don't know what's going to happen after this next halving event. It could be really good, like it historically is, or there's a chance that it's not. And some people with big money in crypto, they want to take some profits up front because, crypto can be volatile. If you're not prepared for Bitcoin to fall back to $20,000, well, you should be. If you're not prepared for Bitcoin to rally to 100,000 plus, well, you should be, because it can be very volatile and you never know what's going to happen next. So bad news in crypto land can be bad news for stocks, and bad news for stocks can be bad news for crypto. And that does seem like what has been happening here over the last couple of days. In the meantime, hit the like button, subscribe to the channel. Let me know what you think about this information down below in the comment section. Again, the next level you need to be watching, if we do break under 438, it's going to be that 50-day moving average and then that 100-day moving average. You could say you have a gap to fill down here to about 420, and that's a nice round even number on the NASDAQ. If we did fall back to 420, that would be a sizable correction. That would be a 6% or so drop on the NASDAQ, but I don't know if that's enough, just given how bullish markets are, how high expectations are, and ultimately valuations. So thank you for watching. Enjoy the rest of your day, and I will see you in the next one.